Today we're out at Prospect Technology and we are trying to determine the cash conversion cycle for year 5. Now the company's accounting department, they gave us some information, but we really need to start by making sure we understand what the cash conversion cycle is. When a company makes an investment into purchasing inventory, right, the whole idea is they want to sell it to end customers. Now they're going to incur some payables from their vendors when they purchase the inventory, and then they're going to have to manufacture, distribute, and sell that inventory. And then they're also going to have to collect the cash from customers who purchase on credit, right? So that is a fairly long timeline. And what the cash conversion cycle allows us to do is to state that whole timeline or cycle in a certain number of days. And so what we need to do is calculate the number of days in inventory, and then we add the days sales in AR, and then we subtract the days of payable outstanding, and that will give us the cash conversion cycle for Prospect Technology. All right, so what we're going to have to do is calculate each of those ratios individually, and then we can plug them into our formula for the cash conversion cycle, and that will give us the correct answer. So in step 1, we'll start with days in inventory. And we can see our formula there. We take ending inventory, and then we divide by cost of goods sold divided by 365 days. And that is better said as daily cost of goods sold, right? So we'll basically take 250,000 divided by 365 days. That means daily cost of goods sold is $685, right? So that's based on year 5. And then we can divide that in to $30,000 worth of ending inventory, and that tells us we have days in inventory of 43.8 days. For step 2, it's a very similar calculation, except this time we're focusing on days sales in AR or DSO. So we have ending accounts receivable net on the numerator, which is 50,000, and then we divide by daily sales or daily revenue. And that's going to be 500,000 divided by 365 days. So on the denominator, we have 1,370. Divide that into 50,000, and that means our days sales in AR is 36.5 days. Step 3, very similar once again. We can see our days of payable outstanding formula. On the numerator, we have ending accounts payable, and then we divide by daily cost of goods sold, which is that $685 again. So 15,000 divided by 685, that means our days of payable outstanding is 21.9 days. So in looking back through each of those 3 ratios that we just calculated, well, the way we can think about days in inventory is that we have 43.8 days worth of inventory, or it takes us 43.8 days from the time we purchase the inventory to when we manufacture, distribute it, and sell it, right? So that is the timeline for this company. Now for day sales and AR, it takes us about 36.5 days to collect the cash from customers who initially pay on credit, right, from the invoice date. And then for days of payable outstanding, that 21.9 days, that means the company waits approximately 21.9 days from when they receive the invoice to when they actually make payment to the supplier or vendor on that invoice. So now that we've done the hard part and calculated each of those ratios, when we plug them into the cash conversion cycle, that's the easier part. Just remember, we start with DIO because we have to purchase the inventory first. That's 43.8 days. And then we can add days sales in AR when we actually sell that inventory, right? We would record the receivable, and that's 36.5 days. And then just remember DPO is last, and that's the only one that we subtract, which is 21.9 days, right? That's what the company has control over. They control when they pay their vendors or suppliers. And so when we do that formula or that math, that means the cash conversion cycle is 58.4 days. So that's the correct answer.